Hello, everyone, and welcome back to another episode of Let's Talk Real. I'm your hostess, Naini. Here with me is Kelly, as usual. Hi, Kelly. How are you?
Good. How are you?
Very good, too. Good to see you again. We took a little break, but we're back, and we are here excited because we have a special guest. Justin Ferris from Enact is here with us. How are you, Justin?
I'm great, Nidhi. Thanks for having me. Thanks for having me, Kelly.
Yes.
Awesome. We're happy to have you here too. We're excited because the topic of the day is definitely something that is so confusing for so many people. There's so many misconceptions, and we're very excited that you are going to come and give some clarity. Today, we're talking about navigating the private mortgage insurance, and Justin is going to be our expert of the day. So thank you so much for coming in and talking to us about this. As usual, we start with the myth of the day, but I want you to go ahead and talk a little bit more about you, Justin, and a little bit about your background and how you got into the world of private mortgage insurance.
Well, thanks, Nidhi. I started in the mortgage business in 1997. So it was actually the week my daughter was born. So I always remember how many years I've been in this. This will be 26 years coming up here in October. I was in mortgages for a while. Then I was recruited to an MI company. I was actually General Electric. We were originally General Electric, GE, in the later 90s. I left and I was in wholesale lending for many years. So I dealt with mortgage brokers and I was in operations and sales management. And then I came back to the company about 10 years ago. I cover parts of New Jersey, Pennsylvania, and Delaware. I'm currently on the New Jersey Mortgage Bankers Association board. And I've just had the experience of being with a lot of different mortgage people, learning a lot over the years from so many people and just having touched different areas of the industry. But I love PMI, and I was like PMI itself. I love the PMI world and the mortgage industry in general.
Yeah, that's awesome. That's great. Thanks so much for sharing that. I mean, I didn't even realize that you used to be General Electric before.
Yeah.
I didn't know that either.
Cool. General Electric, then we were spun off to Genworth, and then spun off to Enact a couple of years ago. So
awesome.
Okay. I know the name Genworth, but not General Electric. So the burning question: what is?
The myth. Let's do the myth.
Oh
yeah.
I'm sorry.
No, you're good. You're good. He's gonna probably touch base on that anyway, right? Yes. So the myth of the day that I feel like that a lot of people do get confused with this one. The MIP and PMI, I mean, even sometimes I get confused with this. So please give us some clarity, and then you can also chime in and explain, what
So MIP and PMI are kind of the same thing. MIP is mortgage insurance premium. PMI is private mortgage insurance. So MIP is what you have to have when you get an FHA loan. It's basically a government insured program as opposed to the private world insuring the loans. FHA is really intended for people with maybe a little bit more of a difficult situation. Maybe their credit's not quite as great, or they don't have the larger down payment. And it's really supposed to be for that kind of segment that they could afford it, but it's just a little bit tighter. And it's a program that's intended for those types of borrowers and buyers. PMI, again, private mortgage insurance, is insurance that we insure the lender against default. So if the loan goes bad, we cover a portion of it, and that allows banks and lenders, to lend loans less than 20% down. Otherwise, they really wouldn't be able to do it, or they could, but the risk would be so great that their capital reserve requirements and other things would be pretty prohibitive. So that's what MIP and PMI are. PMI, there are 6 PMI companies in the country. Again, we're one of them. We also have a India PMI company, and prior to it being spun off last year or 2 years ago, we also had Canada and Australia PMI. So it's a pretty global, program that again, a lot of people aren't aware of that as well.
I was not aware there's only 6 here in the U.S. That's crazy.
Yes.
So, you're even more privileged now to have you here. One of 6.
Well, we're the best MI company too. So.
Yeah, of course.
I use you guys quite a bit. So, and yes, I'm so glad to have you because not everybody, but a lot of people, the burning question is, do I have to pay mortgage insurance? Do I have to pay mortgage insurance? And I'm like, well, of course you do if you're not putting, they don't understand what it is. They just think it's extra money that they're paying on their mortgage payment for nothing. And I, do try to explain to them that this helps to insure us, in case you were to go into default. That's what That's because you're not putting a certain amount down.
Yeah.
So,
Kelly, one other thing that a lot of people don't think about is that not only do we insure the lender against default, but we don't want that borrower to go into default either. So, particularly after 2008, with the collapse, and less so now, it's less often, but when borrowers are in trouble, we work with the lender. We do everything we can to help keep that borrower in that home. We don't want foreclosures. Nobody wants foreclosures.
no.
Yeah.
So we do a lot of mitigation, loss mitigation, to work with the borrowers and help them when they go through a hard time. That's actually, we have a whole department that does that every day. It's just something that we don't think about as well, as it is insurance for the lender, but we're also helping protect the borrower as well.
Well, that's good to know, because believe me, I get the question a lot. And, and a lot of people, even myself, when I bought my house, I was a loan officer. So I structured my loan. I didn't pay PMI, but back then we could get a first and a second. And we ended up having enough equity when we eventually refinanced that I personally have never had to pay PMI, not because I didn't have the down payment money, just because I had that available to me to do the first and second. That's not really a thing anymore.
Well, it's out there. It's just pretty cost prohibitive now. MI premiums over the years have tightened up. It's not as high, particularly for borrowers with higher credit scores. And with the rates, on seconds being probably 10-ish, I'm not really sure, but
they're high.
Yeah, they're pretty high.
I don't know that we even have seconds at Sierra. Some of the banks have them. If you're going to get a second, you can get it through somebody else if you want. But usually it's a bank that, I work for M&T Bank, and that's who I did my loan through. But yeah, I could do a first and a second. So I never, because I had my husband who was like, "Oh, we're not paying private mortgage insurance." I'm like, I structured our loan. You don't have to worry about anything because I took care of it all. So anyway, but that brings me to our next question. What types of mortgage loans typically require PMI, and are there any situations where it might not be necessary? Which I kind of
know.
Right, yeah. As you know, Kelly, any loan that you put less than 20% down on, you're going to need private mortgage insurance. If it's a government loan like FHA, there'll be MIP. VA, there'll be a funding fee. That's again another form of mortgage insurance. And same thing with USDA. They all have some form of mortgage insurance on them. It's just how it's structured, right? There are some portfolio lenders that have they'll self-insure, so they won't put mortgage insurance on it. They'll charge a higher rate, not necessarily lower than what the MI would be in today's world.
So question, back to FHA, because I know with FHA, with the mortgage insurance premium, aren't there certain instances where that eventually drops off depending on how much money the customer puts down? Do you know that criteria?
FHA, I don't think goes away at all.
MIP doesn't go away?
No, so they continue to pay that MI throughout the life of the loan. With private mortgage insurance, once the loan to value hits 78%, it goes away automatically.
Yeah.
Borrowers can also request cancellation after it gets to 80% of the original value. You can also request it based on current value after 2 to 5 years. You'd have to check with your servicer. I actually am co-signed with my son's loan, and I just got a notice yesterday, ironically, that just explains that process. Like, this is when it goes away automatically. This is where you're at. But if you think, oh, you know what, I bought my house 3 years ago. It's appreciated a lot. And you're paying on time. You don't have a second mortgage, because you can't have a second mortgage if you do this. You can call your servicer and say, hey, my house I think is worth this, and what do I need to do to cancel it? And as long as it's within the law, they can cancel it.
Usually they have to order like an appraisal themselves and pay for I've been doing this for 20 years. So in my history, they would have to pay for the appraisal themselves, but they could have appraisal done to show the value of the home is there.
Yes.
Or they can call me and refinance, and it doesn't cost them anything, and I can get rid of it through a refinance.
Yes.
Without them having to pay an appraisal.
And in this market, it actually might be more ideal for you to do and having it refinanced and then refinance for lower. That way, you take away from take away the PMI or the MIP. PMI altogether.
but the mortgage insurance premium with FHA,
It does not go away.
that does not go
Does
away.
not go away now.
Yeah.
So unless they refinance into a conventional.
Yes. Yep.
So
Which it is an
That's
option.
the key
right?
difference.
Yes.
Well, one of the primary questions, I think this might be a question coming up, but one of the main questions I get is, when can you cancel the MI? And they always ask me that, and I'm saying it's not up to us; it's up to the servicer. It also has to fall within the law. There's a law in 1998 passed called HOPA, and that's what changed the rules around MI cancellation. Fannie Mae and Freddie Mac have different rules on it. And as a matter of fact, I do want to just mention, because in some areas this is really popular or common, even if it's owner-occupied 2 to 4 unit, do not follow those rules. If it's a 2-unit owner-occupied property, the MI doesn't go away until much later in the process, and it's not automatically canceled at 78%. It goes for investment properties as well.
Oh, interesting.
And it depends on whether Fannie Mae or Freddie Mac owns it. There's 2 separate sets of rules.
yes, they definitely have different sets of rules. Some of my customers ask this question. Some are very concerned about it and some aren't, but the ones that are, I give them what their loan amount needs to be at in order for them to call and get their mortgage insurance taken away. Like otherwise at 78%, it will go away. But if you want to call
At 80%, yep.
80%, here's what you need to keep an eye out on your, the balance on your mortgage when it gets to this, and you can call and have it removed.
Yeah, that's great.
Some people are very, very concerned with it. And those people I always, at closing, I'm always like, well, here, pay attention to your, you can always make an extra payment every year. That reduces your term by 7 years. That also helps you get you closer to that 80%. So that is definitely something I let people know. So that brings us to our next question.
Yeah. So, how is PMA cost calculated, and what factors influence the PMI rate for the borrowers, if it at all?
So there's a lot of things that could impact it, but really primarily what borrowers should think about is their credit score. The higher the credit score, the lower that MI factor could be. Their debt to income ratio is important. So if they're really tight on what they could afford, it's riskier. So the MI could be higher on that as well. And obviously the loan to value, if a borrower puts 5% down as opposed to 10% down, that's going to have a big impact on the MI factor as well.
Gotcha.
And also, and this is important to know to a lot of people who don't know this, how many borrowers on the loan could impact it. So if you have 2 borrowers on a loan, the rate could be better than 1 borrower. Because if you think about it, if you have 2 people working, 1 person goes through a hard time, you still have that kind of backup. One person.
That's liability.
Interesting.
Yeah. And statistically, it's less risky. So, so a lot of times that could happen. I know sometimes couples or somebody may choose not to have both of them on the loan, and it might make more sense to have them both on the loan when it comes to the MI factor.
Interesting.
I didn't know that. That's good.
Something to keep in
Good to
mind
know.
now. Yeah. To bring that PMI rate down.
Yes. Yep.
That's cool.
Okay. So our next question is, can you describe some of the challenges or misconceptions you frequently encounter when discussing PMI with clients or borrowers? I'm not sure if you...
Well, I think first and foremost is the MI cancellation. I think that's important.
Yeah.
I think a lot of people, let's say somebody bought their first home, 15 plus years ago. Now they're in the market again. PMI rates were higher 15 plus years ago than they are now. So they might think it's this big number. But meanwhile, they're putting 10% down and have a 790 credit score. It's really not that prohibitive anymore. It's a lot less expensive than it once was. It's changed a lot over the last.
I've noticed that. I didn't know that for a fact, but I've noticed it
The difference
over time,
in
the difference
rate.
in the payments that come up, and I'm like, oh wow, that's really cheap.
They might have anticipated it being $120 a month. Instead, it's $28 a month. I'm like,
Right.
Oh wow, that's really not that bad, and I can get rid of it in a few years. It's not that prohibitive. I think that's the biggest misconception.
Yes. Yeah, definitely. Alrighty. So can you provide us some examples of when the PMI might be more cost effective than a larger down payment, like deciding to put less in order to take PMI or not?
So in terms of cost effective, I look at it a little more in terms of somebody being in the best position to buy a home. We never want someone to be in a bad position when they buy a home.
Yeah.
I'm sure Kelly, you and I have seen over the years where some of you are like, it's really, I don't know how they're gonna
There are many closings that I'm just like, yeah, they probably shouldn't have bought a home. But
so, one thing that I encourage, like my friends' kids now are buying homes, and they always ask me questions, and I always explain to them, but you're better off having some money in the bank. So if you need to put 10% down instead of 20, maybe you put 20% down and you have like nothing left. You're much better off putting 10% down, have that extra 20,000 in the bank. My son, I mentioned, bought a home about a year ago, and he had reserves, which is why I let him do it. But he had something went wrong with his septic tank, and then he had a leak in the bathroom.
Like, never know.
It's just the way it is. It happens. So I just think that it makes more sense, and I feel more comfortable as a dad, knowing that he had that cushion in the bank, and that to me is the biggest thing is, don't put every penny out where you're, they call it house poor. You call it house poor.
Yeah.
Stuff happens. Things go wrong, and it's good to have that cushion and just have that peace of mind if something happens.
Yeah. Thank you for saying that.
Yeah, that's a great giveaway actually for any person listening to this. Yeah.
I use myself as an example. When we bought our house, we had to replace the septic the next year because when the house was built, it was not lined up properly. A house of 6 lived in it before us, but it only backed up on them once. And then all of a sudden, it's just my husband and I, and it backs up. And we're like,
yeah, just because.
But yeah,
you never know.
Yeah. We had to get new heating and air conditioning. You just don't know. I mean, we were smart about it, but you're right. They save is.
Yeah, it's welcome to homeownership. You always have to have some savings.
And if you have that extra money in the bank, and as you're paying your mortgage, you have room, pay extra. You pay a couple $100s a month extra. That'll get you down and get rid of that MI quicker as well. But again, it'll save you money in the long run too.
For sure. Yeah.
So that brings us to our next question, which we kind of have answered, but how can borrowers best prepare themselves for the costs associated with the PMI? And are there any strategies for minimizing these costs?
Really, the best strategy is to make sure that you've built your credit score up, that you have good credit. Think about the down payment and what that means. One thing we didn't really talk about is single premium MI. Single premium is just one lump sum up front and then you're done. In some cases, I call it a weird LTV. So if someone they want to put 13% down or something, they could put 13% down and pay for their MI at the same time and still be at that same, loan to value kind of bucket. So that's something to think about as well is get the comparisons. Loan officers like Kelly will show them, hey, here's your option for single premium. Here's your option for monthly. Some cases that single premium makes a lot of sense. Sometimes it doesn't, but sometimes it makes a ton of sense.
Yeah. Especially if someone's trying to stay under a certain amount monthly, and that's what their goal is, that PMI could bring them way higher. So maybe the single premium paying up front when they do have some cash left over might make more sense.
With high credit scores and lower debt to income ratios, that can be surprisingly not too expensive too. So,
and I honestly haven't had anybody ask me that question. So that's a good thing to know because I can bring it up for those who are putting not the full 20% down, but they're putting 10 to 15. Give or take. That's definitely a good. Yeah,
for any loan officers listening, if you go to our website at enactmi.com, you can put in the parameters of the loan and look at the single premium compared to the monthly, like side by side, and get a good apples to apples view of it.
There you go, you guys. Listen, I'm an expert. Just check it out. That's good. Okay, so have there been any recent changes or updates in PMI regulations that potential home buyers should know about, or even just loan officers out there should be aware of?
I think the one thing that comes up, and this comes up every year, I'm not sure if you're familiar with the income tax patches that the government does every year. PMI year after year you've been able to write that off under a certain income level. Every year they have to re-up it. So they seem to do that. I don't think they want to take that away from people because it's more, again, there's an income cap on it, but that's something just to keep an eye on. You'll see in the news every year. They always do it, but it's not a guarantee. It's not like any tax advice or anything there, but but it should be deductible depending on the year and depending on what the government is saying at that point or Congress is passing. So that's something to keep in mind and to keep an eye on.
Yeah, no, that's great advice. Awesome.
So finally, what do you believe is the most valuable takeaway or piece of advice you can offer to our listeners about private mortgage insurance and its role in the home buying process?
So first and foremost, again, without private mortgage insurance, you would need a lot more money down, period. It would be a lot harder to buy a home. For agents out there, it's, there's bigger, home prices because of that. But I think just going back to what I said earlier, I think the most important takeaway would be to make sure you have that cushion, have those reserves in the bank when you buy a home. And I just say that from personal experience or a long time of being in lending. Yeah. You feel so much more comfortable. Again, things go wrong. We've all been there. And it's something to think about as opposed to avoiding, a little bit of a cost to keep that money in the bank and make sure that you're not put in a hard situation. Reserves are really important.
Yeah. And honestly, we always have stressed so many times that being prepared and asking questions early on in the process is really ideal, because the more you prepare, the better you are in putting yourself in a position to buy. So, bettering your credit score, saving more money, having a lower debt to income ratio because you're paying off your debt, but still having revolving credit and building that credit. That just puts you in such a much better position for so many different reasons, not just because of the options available to you for loan types, product types, but also, like you said, for your PMI being reduced because the rate is different for people that are better prepared. So it always goes back to preparing. And that's the whole reason of, even doing this podcast, is really to make people aware that if you decide to buy a house, you shouldn't be buying next day. You shouldn't be talking to people when you are thinking you're ready. You should be talking to people before you think you're ready, because that's how we can better prepare you and help you get to that point. That's definitely the biggest takeaway here. It's just preparing.
Absolutely. Yep.
Yeah, I do like that you bring up that you need reserves, because there's a lot of people that, I have a couple $1,000s in the bank. I can buy a house. And
you can. We are sometimes miracle makers. Trust me.
Well, and it works both ways too, Kelly, because sometimes people will think, oh my God, I need to put 25% down. You don't. You don't.
Not the case.
You can put 10% down and still be very comfortable, and that's okay as well. You kind of hear both sides. There's some people who think, a little bit too unrealistic, and then people who maybe are a little bit too conservative with it.
Yes, correct. And I have talked to a lot. This one young couple. Actually, I think I just worked with the husband. And he thought he had to have. And he had 20% down. I don't remember it was a couple of years ago, but he referred his sister to me. And his sister needs a little bit of work on her credit, and she's like, but I need 20% down because that's what my brother did. I'm like, you don't need 20% down to purchase a home, because not only do you need, yes, you need a certain percentage down, but you have your closing costs, and plus you don't want to diminish all your funds. You want to make sure you have reserves, because what if something happens? But, but this brother and sister, I said, yes, your brother had the 20% down, but you don't need 20%. I said, you will have to pay some mortgage insurance, which isn't what it used to be, but that is a thing.
And in our market, Kelly, in Pennsylvania, we've really never had kind of these elevated home prices. I grew up in New Jersey, and the home prices were always super high. So it was hard to come up with that 20%. It was easier in Pennsylvania up until a few years ago. And with the higher prices, if you need to put 10% down and to get the house that you want, that you could afford, then, I think you should do it and not worry too much about the 20% down.
Right. Yeah. And right now in PA, I feel like the houses are inflated a little bit.
Everywhere. Really.
I just know across the street from my church, they're building these townhomes, and they're beautiful, but they are straight up and down, and they start at $350.
Yeah.
Just a 1-car garage. I'm sure, and I've been told they're beautiful, but $350, that's a lot.
Well, Kelly, one thing to think about, and I do some speaking on this, we had about 15 years of appreciation all happen in 2.5 years.
2.5 years. Yes.
So even though it seems like, oh my God, it's so high, if you were to draw a line from 2007 to now, it's probably about where it should be, and it feels so. It was like you got smacked in the face because it all happened so quickly.
Right. And
It was really happened over a 15-year period.
We just got there faster.
Yes.
Yeah, and people constantly ask me, especially like every time, you see a real estate agent, oh, how's the market? Are the prices coming down? And I'm just telling everybody, look, just be comfortable because these are the new prices. Forget what you thought a house like whatever, my level, 2-bedroom, 3-bath, whatever, cost 2 years ago. This is the new normal now, and it's not anywhere near going down. One big misconception that some buyers have when they come to talk to me is that they're like, oh, the prices are going down because I see they're lowering the price. There's price adjustments. And I explain to them, price adjustments doesn't mean the market value is going down. Price adjustments means that the listing agents are still too hopeful that the market is going as fast as it was. Yeah. And then now they're coming to reality, like, oh, let's just go here. But if you look at that house, so what is sold 3 years ago and what is selling now is still high. So that means they're still up in the market. And I think as of this year, last year we had some tremendous amount of percentage growth for the entire year. But now for this year, we're seeing a pretty steady, lower than normal years, actually about 2.5% so far for this year growth in home price values. So we're still seeing a steady growth. It's just not as 9 or 18% like we had in 2020.
Yeah, no, it'll continue to be, I think, probably 3 to 5 to 6% appreciation for the next.
And not every realtor informs the borrowers like she does that. Like, and even when her and I talk and she looks at a house, she can tell whether or not it was priced like correctly and whether or not it's going to come down. And a lot of times she's right. They end up having to lower the price because
they priced it too high.
Yeah.
And that's the deceiving. Like the news sometimes, the we call it the titles of the
headlines.
News. The headlines, yes. The headlines are deceiving because they keep selling, oh, it's going down because we're seeing price adjustments. But no, price adjustments is just that's what it is. It's a price adjustment. It's not a market value decrease in our market.
The other thing is interest rates going up. So they more than doubled in 4 months, back in 2022. So so not only do we have the higher prices, but we have the higher interest rate. Interest rates this is where a normal market should be, but people don't think that because the rates were so low and, we have all these people sitting on these low interest rates. I think that's another reason like people aren't selling their houses because they're building equity in the house because they have this low interest rate. So they're going to stay in that house with that low interest rate for as long as they can so that they have equity to sell and put down on a new home. But the interest rates are and I still to this day, literally last week, I had people be like, so what's the interest rate today? I'm like, well, I can't, just like.
It changes for every person.
Just like mortgage insurance, it's different for every person because it depends on your credit score, it depends on your down payment, it depends on your loan product and your DTI. There's so many
variables.
Things.
Yeah.
So I'm like, I can say the interest, you can get an interest rate anywhere between 6.25% to 7.5%. Mm-hmm. And that's the range I use because I have no idea.
Yeah.
And it's.
If you really think about it too, we were sitting at 4.5% back in 2019 on average. So if nothing happened, if COVID didn't happen, we probably would be sitting in the 6s anyway, if we just follow inflation naturally throughout the past 3 years. So it's just that we felt that increase all at once from very low, which it was not normal, within 3-4 months, it doubled.
And that was the government was buying mortgage-backed securities by the billions for over 10 years. And once that stopped, that's when the rates went back up to normal. So they were artificially low. And if you think about it, almost anyone under 40, probably, if they bought a house, it was in the last 15 years, the rates were super low. So most people that are home buying had never seen the higher rates we have, or I have at least. But most people were not used to that 6.5 or 7, which was normal up until 2008, 2009. So
and even one of the one times I refinanced with getting, I've always been with M&T, and that's why I always refinanced through when I did. our interest rate at one time with the M&T discount, because I have all my accounts there, I still had 4.25%. And that was, I don't remember what year that was, but that's a good interest rate.
That was super low. Yeah, back
So,
then.
and everybody keeps talking about them going down, and they're not.
No, it's just the sixes is probably more about where they will settle in. I mean, I don't know. I've been wrong a lot of times. So
yeah, well, I mean, we all have been in
probably
this last 3
settling
years, so it's just crazy. It's a lot of bad speculation.
Every high marketing person that has been, I mean, I saw some interviews when I worked at Fairway with some guy who, he worked for the presidents and all that. They said May 10th, their interest rates were going to go down. Well, guess what? May 10th came and went.
Yep.
And the interest rates.
And then they said something about August.
Yeah.
August came and went. We're still
and I'm just
steadily there.
And I don't have too many people ask me about that, but when they do, I'm like, listen, interest rates are what they are. That this is where it's going to be. If they go down, they go down. Maybe in the presidential election, maybe, but I'm not saying that.
Depends on the inflation. Yeah.
Exactly. Yeah, it really is a reflection of inflation. Where inflation is at, interest rates kind of tag along a little behind, but it does tag along.
Yes.
But I do have a question for you. So how have you seen between has COVID and just this market, this crazy market, how has it affected you guys? Obviously it affects us because we're super slow, but how do you guys?
Am I, or are you talking to Nini?
She's asking you.
I'm talking to you. You're the guest. She's sitting next to me. So
well, it's changed a lot in terms of my job, my role. It has changed the structure of our routine a little bit. It's a little bit harder to get in front of people.
Yeah.
Kelly, I've met you in person a number of times. I like to be on the road. I like to be in front of my clients.
Yeah.
Over the last couple of years, we've done a lot more of this. A lot more webinars and Teams meetings and email, just different ways to try to stay engaged with our clients in order to bring value. And I definitely over the last year and a half, that's kind of opened up more. I've done a bunch of lunch and learns, for example, for realtors this past year, and it's kind of expanded more in that way. Outside of that, Kelly, just like you or Nini or anybody in our business, when it's busy, you're busy doing business. When it's slow, you're busy trying to get business. So that really hasn't changed. It's
changed much, right? That's just dynamic of the market, seasonality and everything.
I mean, this business changes, so many times over and over again, and you have to kind of roll with it and keep working. And we base our business on relationships too. And just like all three of us, it's effort and relationship, and that's what we try to do every day.
Yeah. Okay. That's really it.
Yeah, it's pretty much says it all. So you're just like me. So it's good to know, just like both of us.
So anything else that you would like to share just to kind of close in for today, Justin?
No, I just want to thank you so much. This is fantastic. You guys are great, and I appreciate you having me.
Oh my gosh, thank you for coming.
Yes,
this definitely brought some
much.
Clarity for myself, especially on some parts, and definitely even for Kelly.
Yeah, a couple of things that I learned today. So there's always something.
There's always something. Nobody knows everything in this business. I know that.
And she thought that we would run out of things to talk about. I'm like, there's
always something to talk about.
We're never going to run out of things.
Who doesn't want to talk about PMI?
Exactly.
And for anybody watching, if you guys do want to get in touch with Justin, I know maybe loan officers out there that would like to have this connection. I have his information going through here in the bottom. So feel free to reach out to him if you have any questions at all. And if you are a buyer or seller, don't call Justin. I don't think you're going to be helpful there, but you can call Kelly and I. We'll be more than happy to answer any questions you may have. So I think that's it for today. Thank you guys for your time. And thank you everybody here for watching. This is another episode of Let's Talk Real, and I'll see you guys in the next one. Bye-bye.